Hello my fellow investors and welcome back to another stock analysis video. Let's do another one of your recommendations, guys, and we're going to take a look at the company that was recommended by Joseph Idem. I think that's how you say your last name. Thanks for your analysis. This was on the video for CHS. Can you please check SHLS, Shoals Technologies? I really would appreciate it. So let's actually take a look at this company, guys, and see if at the current share price, it is like a good buy right now. Before we actually get started with any numbers, let's just get started with understanding what this company even does, right? For all of those of you who may not know, they are in the business of solar energy. So, you know, that's an upcoming thing. However, a lot of the technology there still needs a lot of improvement, but you can see that they produce components like cable assemblies, inline fuses, combiners, disconnects, recombiners, wireless monitoring, etc, etc, etc. So guys, they essentially make systems for solar energy production. And now coming over here to their latest earnings, they had earnings on the 14th of November. EPS normalized actual came in at 10 cents, which was a beat by 2 cents. EPS GAAP actual came in at 7 cents, a beat by 2 cents again. Revenue of $90.82 million, which is a beat by $7.85 million. So let's actually come over here into the calculator. We got the ticker symbol for SHLS, market cap of $4 billion with a PE of 176.32. That is a massive PE, guys. And on top of that, take a look at this. Their share price is only $24.76. Now, taking a look at this on the 1 year, you can see that they are up 9.8%. Year to date, well, we've only had like, what, 4 days? So this one doesn't really matter that much, but so far they're up 3.43%. 52-week ranges is $9.58 to $32.43. Now, coming back over into the calculator, we can see that they do not pay out a dividend, which is actually kind of good, especially with this kind of PE. So if they do not pay out a dividend, this means that all of their cash flow is going straight into themselves to grow the company, make acquisitions, buy back shares, etc, etc, etc. Now let's actually analyze the fundamentals, starting of course with the net income 5 years ago of $8.6 million to $13.2 million. That is an increase, guys, of 53%. However, take a look at this. So 5 years ago to 4 to 3 years ago, massive increase, guys. And then, well, 2 years ago, it went down from 33.8 to $2.3 million. Now you're probably looking at this and you're like, oh, COVID related. Actually, no. So this $13.2 million is actually 2022. So 2 years ago was 2021. Yeah, they did not fall during COVID. They fell after COVID, which honestly, a lot of companies like these, a lot of like EV companies really fell like the following year after COVID, since the hype was like dying down. So the fact of the matter is that we do see this massive rise going from 8.6 to $25.1 million and then just a crash. So overall, I have to give this like a 15%. Actually, I'm gonna go with like a 20% on this one. Looking now at the free cash flow, 5 years ago of $1.6 million to 1 year ago of $3.6 million. That is an increase, guys, of 125% with an average of $16.5 million. Now again, we do see something similar to that of the net income, right? We see a rise from 5 to 4 to 3 years ago, just like we saw in the net income, and then a fall 2 years ago. However, this fall went into the negatives. 2 years ago, the cash flow was negative $8.2 million, and then they recovered to 3.6. Guys, not only is this rise from 5 to 4 years ago bigger than that of the net income, but the fact that they went into the negatives 2 years ago, there's a major concern. I have to give this, like, I mean, I don't even know. I'm gonna give it like a 5% because I guess they are up overall on the 5 year, but these numbers are just not really that good in my personal opinion. Looking now at the revenue, this is what it should have been when it came to the net income and the free cash flow. This kind of increase is exactly what I'm looking for. 5 years ago of $104 million to 1 year ago of $280.3 million, increase of 170%. Now they did have a pretty big increase. I wouldn't say big, but a pretty moderate increase from 2 to 1 year ago. But overall, guys, you know what? I'm actually going to give this a 100%. Really solid, but the revenue, you have the free cash flow and the net income really bad. The revenue is good, but it's not just about the revenue. You want other metrics, especially in the profit metrics, to be really solid as well. Looking now at the total assets minus total liabilities. The current year, it is today, so you obviously ignore it because we don't have the numbers so far this year. It's only been 4 days. But if you take a look at this is not good at all. So 3 years ago, they went down to negative $184.1 million in this difference. And then 2 years ago, they were still negative at negative 7.5. 1 year ago is when they went back to positive. And the only other time where they have been positive in the past 5 years, it was 4 and 5 years ago. So they got hammered here hard. And only 1 year ago is when they went slightly positive to $22.7 million. Not only that, take a look at this. Average total assets is $335 million. Average liabilities is $339.55 million. That is a difference of negative $4.75 million. That means that they have a lot more liabilities than they do assets. So yeah, that's actually really bad. I'm gonna give this like a 5% because I guess that they have been positive in the past year. So sure, 5%, I guess, but overall, this is just all over the place. I do not like this at all. Looking now at the cash flow minus the liabilities. This one is not looking good either. Now, they did have 1 year where they brought it up from negative 45.75 years ago to negative 3.2 4 years ago. But then after that, it was just like massive drop. They went from negative 3.2 million to negative 328.5 million just a year later. And then they continued to fall at a pretty moderate pace, honestly. 1 year ago was their lowest point at negative $503.6 million. So, I'm going to give it like, I don't know, 5% again. They had 1 year where they went up slightly, right? And then after that, it was just massive crash. So, I'm going to give it 5%. Looking now at the shares outstanding. This one is interesting because I was not expecting to see this from them. Since they don't pay out the dividend, I thought that they were going to be issuing shares. Now, they have, kind of, but on the grand scheme of things in the 5 year, they went from 160.3 million shares to today of 113.5 million shares. Guys, that is a massive decrease of 29.2%. However, take a look at this. From 3 years ago, since they dropped it from 160.3 million shares to 93.5 million shares, they have been issuing ever since. The reason why this year is the same as 1 year ago is because we don't have data for this year. So I just kept it the same, so that way the numbers work out. But you can clearly see that they have been increasing it very consistently within the past, 3 years or so. And on top of that, take a look at this. Previous to the current year is an increase of 1.34%. Overall, I'm going to give this like a 50%, I would say, because they did do a massive buyback. And they have instances of keeping it the same, just like we saw here from 5 to 4 years ago. So I'm going to give it the benefit of the doubt and give it a 50%. Cash and equivalents, they currently hold $11.2 million with an average of $6.7 million. If we come over here to the weighted grade, guys, we gave the net income of 20%, free cash flow 5%, revenue 100%, assets minus liabilities 5%, cash flow minus liabilities 5%, shares outstanding of 50% with a total grade of 34%. Yeah, this company has a lot to fix in my personal opinion. Free cash flow, net income for starters. Those are like the major two. And then hopefully once they fix that, then they can get their liabilities under control because their liabilities are just all over the place. So fortunately, it's really bad. 34% is not even close to passing. But let's actually use this kind of free cash flow to see what we can actually pay for this company. So coming over here to this kind of free cash flow, if you believe this company has a future with a 34% of my grade, they have a long way to prove to me that they do have a future. But let's actually use this kind of free cash flow to see what we should pay for it today. Current share price of $24.76. Let's use revenue growth, predicted share buyback, and keep a required rate of return of 10%. Looking over here at Seeking Alpha's revenue forward, it's 42.81%. Yeah, no, absolutely not. Absolutely not. I refuse to believe that. I'm going to go with like 5, 6, and 7% for the revenue growth. And I'm being very generous about that. And when it comes to the predicted share buyback, let's actually say that at best that they'll do, I don't know, like 2% share buyback For the median, let's go with 0, and for the lowest assumption, let's go with -2%. Negative just means that they're going to issue shares. And now with that, guys, we get the target share prices not adjusting for debt of 17 cents to 18 cents. You're probably looking at this and you're like, you have two 17 cents with completely different numbers. So let's actually see that. The reason why this is happening is because there's nothing wrong with the calculator. It's just that the numbers are so small that in order for me to actually let you guys see it, I have to increase the numbers of zeros. So it's actually 16,5481 cents to 17,4723 cents. So yeah, that's the reason why that's like that. It's nothing wrong with the calculator. It's just the numbers are just really small when it comes to when this calculator actually does everything that it needs to do. So it's coming out as 17 cents for both. And the highest ones, again, 18 cents. Now, adjusting for debt, this drops into the negatives, meaning that they have a lot more debt than they do cash on hand. That's why it's going into the negative. So, guys, that's a massive drop, right? $24.76 to 17 cents, maximum 18 cents. Actually, technically, the lowest is 16, but you guys get my point. Basically, this thing has to fall a significant amount. Now, for all those of you who may say, that's too much, it'll never fall that, it's just impossible. Well, let me just remind y'all what the PE was, 176.32. Yeah, it needs to fall a significant amount. So that's the reason why my calculator is getting this much. Basically projecting that revenue into the future and bringing that back to today, it's just not enough. Like, it really isn't enough to justify this current valuation. Now, for any of those of you who may be like, no, that's wrong, I don't care, it's wrong. Okay, let me bring you guys a second opinion, because, you know, I would like a second opinion as well, especially if you don't believe this. So let's come over here and see the book value per share. This takes into account 0 assumptions. Basically, we take the total assets minus the total liabilities, and obviously, like, we add them, i.e. they're going to be subtracted, and then we divide that by the current shares outstanding to get the value of the company in the books. And we get today, guys, after this math, we get 23 cents. Yeah, and not only that, take a look at this. 5 years ago, it was $1.54. 3 years ago, when we saw all the nonsense happening, -$2. Guys, yeah, the fact that my calculator is telling me around like 18 cents, 17 cents, and book value is telling me 23 cents, I'm onto something here. Now, when it comes to the tangible book value, this is in the negatives. I'm gonna pretty much ignore it. And looking at this kind of valuation using the price divided by the current book value, well, we get the ratios of 107.65 for the price divided by the current book value. Very much overvalued. 1.00 is at price. Let me just put that into perspective. 1.00 is that price. This is at 107.65. It's overvalued no matter which way you look at it. Book value, this kind of free cash flow, it's just not a buy, especially with those fundamentals. Now, that is my personal opinion. You guys do whatever you want. I'm not telling you what to do with your money. You do whatever you want to do. This is not financial advice. Every investment is the present value of all future cash flow, though. So understand that if you put your money into this company expecting, you know, 10x, 20x in the future, the fundamentals just aren't there for that, right? The cash flow into the future just isn't there to justify those kinds of gains. So if you do plan on getting into this company, if you really do believe in this company, guys, again, for fair warning that you may not get the results that you may want. You could get lucky. I'm not saying you can't get lucky in the short term, but in the long term, unless something tremendous happens in the solar energy business, I don't foresee this to go, you know, 10x anytime soon, especially if you're going to overpay at this current price of $24.76. So guys, have this calculator. It's for free. Please make your own assumptions. I have the book value available as well, the reevaluation and dividend tracking sheet, so that way everybody can make your own assumptions. I have it for free for that reason. The only thing I ask for in return, every single video I say this, is just help me grow my channel, like, subscribe, comment. It really does help grow with the algorithm on YouTube. I might get a couple haters when it comes to this video because, you know, I guess I'm wrong. I don't understand this company. I don't understand this valuation. You're absolutely right. And it's funny because, like, one of my commenters saw a video I made a while ago, and he's just like, the stock was like, it's currently at like $56. And like, yeah, when I did that video, it was like at 86, and he told me that, like, I was saying that the price should be at around 60, and he was just like, yeah, it's under 60 now. I'm like, yeah, there you go, exactly. Because at the end of the day, every investment is the present value of all future cash flow. I don't see it with this one. If you guys want to invest in it, you do you. That's why I'm giving this calculator out for free. See where these numbers land. All I'm asking for in return, guys, for your support on the channel. I got no sponsorships. This is me, myself, and I. Like, subscribe, comment. It really does help her with the algorithm on YouTube. All in all, when it comes to Shoals, final thoughts. Basically, I'm not saying that the solar industry is dead. I'm not saying that at all, but it does have a lot of hurdles. It really, really does. And, well, the fact of the matter is that, let's face it, we just saw the energy sector like skyrocket these past like 2 years, right? Absolutely skyrocket. Energy sector was the only emerald green in the past year when we saw that stock market heat map, right? On the 1 year. So not surprising that when it comes to this kind of company, it does have a lot of hurdles. Does solar have potential in the future? Sure. But again, every investment is the present value of all future cash flow. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out. And I will see you all in the next stock analysis video.